a recession really is baked into the cake. The money supply in the United States has been contracting actually for about 10 months. That's shrinking the money supply. And when that happens, with a lag of about 6 to 18 months, economic activity starts changing. And so a contraction means what? It means a recession. And if the Fed continues to have this car in reverse, we're going to probably have a pretty good recession, maybe one that will last quite some time.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. When he was on this channel back in August of 2021, when inflation was 5%, today's guest made the bold prediction that the CPI would eventually hit 9%, which it indeed did the following June. So where does he see inflation headed from here? To find out, as well as hear his latest outlook on Fed policy, the US dollar, recession risk in the markets, we welcome back Steve Hanke, Professor of Applied Economics at the Johns Hopkins University in Baltimore, Maryland. Steve, thanks so much for joining us today.
Good to be with you again, Adam.
It's always a pleasure, Steve. I follow your work closely, especially your Twitter account. You have been at no loss for words of many things that have been happening in the economy and in the markets and geopolitically this year. Lots to talk with you about here. Before we dive into it all, though, I want to ask my normal high-level starting question. What's your current assessment of the global economy and financial markets?
Well, starting at the epicenter of things, the United States, I think a recession really is baked into the cake. The money supply in the United States has been contracting actually for about 10 months. That's shrinking the money supply. And when that happens, with a lag of about 6 to 18 months, economic activity starts changing. And so a contraction means what? It means a recession. And if the Fed continues to have this car in reverse, we're going to probably have a pretty good recession, maybe one that will last quite some time and be deep. We can get into that in detail later. But so that's the starting point always, is that the main thing is what's going on in the United States. Europe is in bad shape. They've essentially also money supply has been slowing way down, so that's a key. Same with the United Kingdom, money supply slowing way down, credit getting squeezed, and the war against Russia that's really being led by the United States is really throwing a spanner in the works, not only the U.S. economy but also the European economy. So those are the two big ones. Then you've got another real big one with China, and it's coming back and slowly coming back online after stupidly imposing these lockdowns. We've done this big study at Johns Hopkins with Jonas Herbe and Lars Jonig. Herbe's in Denmark and Jonig is in Sweden, and I'm of course at Hopkins. We're public that research we did will be published as a book shortly, but the conclusion was that lockdowns essentially don't do anything to improve public health, but they kill the economy. And what did they do in China? Well, they had severe lockdowns and it really crippled the economy. But they're kind of coming back out of it. So that's a plus. In India is doing okay. Indonesia is doing okay. So that's kind of the big ones in Asia. So the picture is kind of bleak, I would say, and one in which there's a lot of uncertainty. Not only bleak, but we don't know how severe the storm is going to be. There's definitely going to be a storm in the United States, and there'll be one in Europe, and there'll be one in the UK. Exactly how intense that storm will be, no one really knows yet, but it seems like these central banks are hell bent on continuing what they're doing stupidly to over squeezing the money supply. They're not paying attention to the money supply, over squeezing it with quantitative tightening. And the Fed and the ECB and the Bank of England clearly are just basically have been flying blind. I mean, they're not looking at the money supply, so they're flying blind. They're driven by daily data that come out, short-term data. They're called what they call data driven. They're not looking at the quantity theory of money that relates the changes in the money supply to economic activity, prices, and things like that. They're looking at daily data. So a lot of noise. They watch the noise. They don't watch the signal, which is the money supply. The signal's the money supply. It's the only thing that counts. And they listen to all the noise coming out every day. So that's kind of 30,000 feet. That's kind of a starter. So you got to be very careful. Storm clouds are gathering.
Okay, great. So gathering storm clouds, you feel relatively confident a recession lies ahead, baked in the cake, especially if the central banks continue to focus on the noise and not the signal. You didn't mention the markets. We are going to get a chance to talk about that in depth in a bit, but I assume you're not very optimistic about the general economic conditions. Should I presume that you're not generally optimistic about the market conditions going forward?
No, I'm not. And I said the volatility and uncertainty, especially with these sanctions, the U.S., weaponizing the financial system is extremely dangerous. And I don't think it's really made a big bite yet, but it could. And it just throws a lot of uncertainty in the markets. It did disrupt the oil market, of course, and the grain markets for a while, but the financial markets have been kind of immune from financial sanctions so far. But I say so far, because financial sanctions, by the way, the reason that financial sanctions are so stupid is twofold. One, if you put sanctions on, that goes against the principle of free trade. And the principle of free trade is really what's behind prosperity and growth. So that's one thing holding back, by the way, the international economy. When you said my broad view of things, one thing holding back broad growth throughout the world, which you can look at the IMF does these forecasts, these big global forecasts, and they've got a pretty low growth scenario coming out of the IMF forecast. And one reason for that are these sanctions. And the sanctions are anti-free trade, anti-market, just anti-prosperity, anti-everything. I mean, they're absolutely stupid in terms of principle, but in practice, they're even worse in the sense that they never accomplish their stated objective. So if you're going after somebody and you want regime change, you want to change your regime in Korea. Well, we've had sanctions on Korea for decades. What's happened? Oh, Cuba. Let's overthrow Castro. That's a great idea. We put sanctions on. Well, what do we have in Cuba? How about Maduro? This is one of the most stupid cases in Venezuela. Maduro was weak. He was in power. He was floundering around. We put sanctions on. That was 10 years ago. We've kept Maduro in power. The U.S. policies of sanctioning Venezuela are the only reason Maduro is in power right now. He's actually had 2 hyperinflations in those 10 years, a complete disaster. But with sanctions, what do you get? You get a rally around the flag effect.
Right.
And it keeps Maduro in the saddle. So the history of sanctions is one of a complete disaster as a policy. They do not accomplish their stated objectives. But the U.S., and by the way, this is very bipartisan. If you think this is just Biden doing this, no. We were doing it with Bush big time. In fact, after September 11th, George W. Bush ramped up financial sanctions fairly severely, and they were followed by the Obama administration, and of course Trump also, and now we have Biden, and with Biden, of course, there's like tripling down because Biden has entered a proxy war. The U.S. is very involved, by the way, in this war. If you look at these leaked papers that just came out, for example, it's very clear the U.S. is doing everything except sending battalions of ground troops into Ukraine. So this is another thing that people aren't thinking about. When you talk about markets, you better be thinking about things like this. So that does get to one market. Gold has been pretty strong, by the way. And one aspect is a safe haven thing. So you have a war going on. Okay, that's good for gold. You have a banking crisis. That's good for gold. And you have a recession baked in the cake. And usually, when a recession comes, about 6 months before the recession, and going into the recession, during the recession, gold is strong. So that's one market that's a pretty safe bet. You're not going out too far on a long plank if you're going to be long gold with the kind of environment that I'm describing right now.
That we're in. Okay, great. Well, look, I want to get to more discussion about gold specifically, as well as the other assets you think are either well positioned or poorly positioned, given the macro environment you just laid out for us. But we got some ways to go before we get there. So let's if we can let's talk about central banking for a moment here, because that is what is driving a lot of the action. And particularly, you said that, look, these guys are looking at the noise and not the signal. They're continuing to tighten here, while the most important metric that you said, money supply, is contracting, and we've not seen a contraction in M2 for decades and decades and decades. So, Steve, as you had talked about, the Fed and the world, other central banks, they ended up creating the 9% inflation that you had been warning about, right? So they were complicit in creating that inflation. They certainly waited too long to take action against it. Now they've raised rates further and faster in the shortest period of time in the data series that I know of here. So I want to ask you basically two things. One is, we might be in danger of the Fed and the other central banks over tightening, right? And as you said, creating a recession, perhaps even a worse recession than might be necessary here. So there are two things going on. Like, even if the central banks pause right now, right, and a number are beginning to, right? I think Canada, Australia, India have all announced pauses. Powell is talking like, maybe I got one rate hike left in me, but I'm going to see. But even if they pause here, we've got the lag effects from all of those rate hikes that the Fed's made over the past year that take about a year-ish or so, better than I, to fully manifest in the economy after the Fed has made the decision. We also have tightening lending standards going on now that have been exacerbated by the banking crisis. And Jerome Powell said recently that those sort of substitute as additional rate hikes, which is one of the reasons why he's saying, I'm going to kind of wait until the next FOMC before I determine if another hike is needed or not, right? So my point is we have all of these additional impacts that are going to serve to continue to contract things, even if the Fed just tries to stay flat from here. So two questions for you. One is, how important are those factors I just mentioned, the rate hikes and the credit tightening, in terms of kind of making things worse from a contracting standpoint? And then secondly, do you think the Fed is going to be able to hang in until inflation is truly tamed, or are these the gravity of these contracting forces going to break something systemic and force the Fed to step in because feels like it has to save the system at that point?
Okay, now, Adam, to unpack that, actually, you've asked about 20 questions, not two.
I'm sorry, I did.
So let me just kind of ramble around over the territory that you were covering there. First, the inflation story. I think, as you mentioned, John Greenwood and I were the first ones to actually forecast and put a number that was correct on where inflation was going to go, and that it would be permanent. It would persistent. It would be persistent, not permanent. It would be persistent, not temporary.
Mhm.
And we did say it would go up to 9%. It actually went to, at the peaked at 9.1%, the headline CPI in the United States. So the question is, now where are we? Well, about a year ago, we using again the quantity theory of money, focusing on the money supply, MV equals PY, we indicated that by the end of 2023, that's this year, inflation would be around 5%. So it would be coming down towards 5%. Then about 2 months ago, we noticed and that the money supply was contracting. And not only that, and I'll get into this in a minute, but the loans and leases put out by the commercial banking system, which are a big contributor to the money supply growth, those were actually slowing down a lot. Banks were cutting back. This was before, Silicon Valley Bank and all First Republic and all of that hit the fan. So it was already slowing down the bank credit. So we revised based on the declining and contracting money supply and the squeezing of the credit in the commercial banking system, our year-end inflation forecast, and now it's 2 to 5%. So it's a big range, but it's coming down. So the inflation story is in a way over. They've already overdone things so much that inflation is coming out of the system, contrary to what the Fed keeps telling us. Greenwood and I are looking at the money supply. If you look at the money supply, what's that tell you? It tells you it's contracting so rapidly that with a lag of 12 to 24 months, we know that inflation starts changing. And that's why we've revised our inflation forecast from 5% at the end of this year to a range of 2 to 5%. So that's the first thing. And remember, you did talk about lags. Remember, the lags are important, and people have to watch the money supply. And then the lags are as follows. In 1 to 9 months after the money supply starts making a significant change, you get changes in asset prices. That's, equities, for example, home prices, sensitive commodity prices, those start changing. Then with another lag of about 6 to 18 months, you get changes in real economic activity. That's changes in real GDP. And that's why we know the recession is baked in the cake. We've had a huge contraction in the money supply. So after 6 to 18 months, you're going to get a recession. Well, we've had 11 months of monetary slowdown. So we know this, it's right around the corner, the recession and a weakness. And then the ultimate lag, 12 to 24 months, you get changes in headline CPI. So that's the lag part of the story. And the reason people get confused, they don't understand the lags. Most people are data driven. They're looking at what's happening today in the economy. So you get a lot of noise. Number one, that's a big problem. So what should you look at? You should look at what's going on in the money supply, not only today, but what's been going on in the last year or so with the money supply. But people don't look at that. They look at what's happening today, and they don't get these lags figured out. It's very, very confusing for most people. So that's kind of the lag story. Now let's talk about the bank credit for just a little bit. most people don't understand that the money supply in normal times, about 85 or 90% of broad money is produced privately by banks. It's not produced by the Fed. It's private money. It's credit, that loans and leases that have been extended by the commercial banking sector. And if you look at what's been going on in the commercial banking sector, we were up at the in last summer, we were up to year over year growth. Well, even as late as July, for example, of last year, bank credit was growing at 10% year over year. And now it's down. On February, it was down to 5.5%. And it's going down very fast. Credit is really being squeezed now because it was going down, it was trending down. And then we had the banking blow up with Silicon Valley Bank and so on. So that contribution has actually been positive. It's been slowing, it's been diminishing, but bank credit is maybe going to end up going in negative territory. It could actually start contracting if things develop as I think they might. In any case, whatever they've been contributing, forget it. It's going to be nil. There's not going to be much contributed by the commercial banks. And if the Fed is quantitative tightening and reducing the size of its balance sheet, even if it leaves the Fed funds rates where they are, or maybe takes them down 25 basis points or something like that, you're still going to have this massive downward contraction in the money supply continuing on. It's been going for 11 months, but it's going to be continuing on. And all that means is that the recession will last longer than otherwise would be the case. So that gets to another part of your 50 question thing and two. And that is, well, what should the Fed be doing? Mm-hmm. And if you look at the quantity theory we use the quantity theory of money, as John Greenwood and I do, and we calculate we call a golden growth rate, Greenwood and Hanke golden growth rate. And that is the growth rate in the money supply measured by M2 that is consistent with the Fed hitting its inflation target of 2%. And that's more or less between 5 and 6%, just back of the envelope. But let's just say 5.5%. Well, what's the growth in the money supply right now? As I look at the number, the year over year growth rate in U.S. money supply is minus 2.35% year over year. It should be growing at plus 5.5 to be consistent with hitting an inflation target of 2% and using the golden growth rate. But they don't look at the money supply. They don't look at things like the golden growth rate. So again, they're flying blind. These people are really, I have to label them just incompetent at this point. And what's my evidence? My evidence is pretty clear. They were not able to forecast inflation. Remember, they said it was a temporary little glitch that was going to go away because of supply chain problems and things like that. They still talk that way, by the way. but now they've switched into, it's kind of persistent, and we have to keep fighting it. And as Greenwood and I have pointed out, no, that fight is already over because they crushed the money supply so much. So another thing I would like to point out, you said, well, central banks all over the world have been, pumping up money, giving us a lot of inflation. Well, that was true. The US did it. The United Kingdom did it, the Bank of England, and the European Central Bank. That's true. But what about, and so everybody says, oh, inflation, it's global, it's global. No, it's not global, it's local. It depends on what local central banks are doing with their money supply. Now, the three that I just gave you were pumping, and they got a lot of inflation as a result of that. But if we look at China, where's China's inflation now? China's inflation is 1% per year. China didn't pump anything. What about Switzerland? Their inflation rate's 3.4% year over year. They never pumped anything in Switzerland. What about Japan? Their inflation rate's 3.3%. They never pumped anything in Japan. So you have to look locally at what these local central banks are doing to the money supply. And another problem, and you mentioned this, I think you fell into the trap, Adam. Let me quote Milton Friedman. Monetary policy is not about interest rates. It's about the rate of growth in the money supply. It's the money supply. So that's, I think, covers at least partially what you were asking me.
It covered an awful lot of what I was asking you, and you covered a few things I was going to ask you. So that was a wonderful answer there, Steve. First off, I want to just comment that we had Lacey Hunt on our recent conference about 3 weeks ago, and he thinks very similarly as you, which when I see very smart people coming to similar conclusions, it lets me lean into those conclusions more, which is great to hear you guys seeing things quite similarly here. When talking to Lacey, sort of made the analogy of inflation is sort of like a mortally wounded bull elephant, which is, it may be shot, it may be on its way to dying, but it's going to trample around for a while, do some destruction before it finally keels over. Right now, it seems like everybody's still focused on that elephant, thinking that inflation, is going to be the beast we have to still kill. But you're basically saying, no, it's mortally wounded. At some point here, it's going to keel over, and then we need to worry more about what comes next.
Right. I think that's a good way to put it. I think that, I said baked in the cake. Well, you can, the elephant or bull that's been mortally wounded, and it will go down. Now the thing that's interesting about the reason I like the bull analogy is that it will go down, but it might, ramble around all over the place, and that's the noisy data.
Right.
That's looking at so we're going to get an inflation number this week, and I anticipate it's going to be weak and going down, but you never quite know. There are zigs and zags in these data that throw people off base. But the fundamentals are what has been going on in the money supply 12 to 24 months prior to the inflation number that you're looking at, and that will tell the tale. And given that, I know the bull's going down. The inflation is that part of the story has been licked already because
right.
because the Fed was excessively tight. They overdid the thing, and the reason they overdid it, they're not looking at the thing that counts. So changes in the money supply.
Right. So in our elephant analogy, they're looking at where the elephant is trampling next. They're not looking at the fact that it's got a bullet hole in its heart, and they can count that it's going to go down at some point in the near future. So when we talk about the primacy of data like the money supply, you mentioned that the current reading is negative on a year-over-year basis. In terms of its momentum, is it still continuing to contract here? In other words, like, you basically said what's important is the trajectory of the money supply, because that tells you where things are going to be in the future. And if it's continuing to contract, then it should suggest that things are going to continue to worsen in the future, as opposed to like, hey, at some point we're bottoming and we can start feeling optimistic about things 6 months, a year out, whatever. But is it still heading downwards?
Oh, yes. Now, this is a very critical point that you're raising. So So it's one thing to look at year over year data, but what it always happens, you have to look at things at the margin, a
Right.
little closer in. And if you do that, and instead of looking at year over year, if you take the 6-month numbers and annualize those, and remember, year over year is contracting at minus 2.35%, but the 6-month annualized is declining at minus 5.4%. It's accelerating. It's accelerating. Then if you look a little shorter at a 3-month period and you annualize that, it's even going down faster. It's minus 5.7%. So the momentum, you used the word momentum, it's accelerating. The contraction's accelerating. And what is worrying actually, and it comes back to the banks, because banks have been really bank credit has been the only positive contributor to that shrinking money supply. Okay. And what did we just say about banks? We had the banking crisis, all of this, and they're kind of decelerating the credit growth, but I think that's going to go very close to zero, actually. So this means that the broader M2 number, the money supply number, that momentum that I just gave you will probably get worse. There's nothing positive about what we were talking about relative to the money supply. Everything is looking negative.
All right. So we're basically entering a storm, and as we're heading towards it, we're seeing the storm clouds. You mentioned those at the beginning of the video. The storm clouds are getting bigger. They're getting darker. The winds are picking up. The weather's getting worse. So as we look out towards the storm, for all the reasons you just mentioned, I got to point out the disconnect right now between, what the Fed is telling us, right, which is I'm going to continue, pursuing inflation. Powell has basically said, if needed, I'm going to hike more, but if not, I'm going to pause and I'm going to hang out there for the rest of the year, right? Like I'm not planning on changing policy at any point in time. Yet the markets are predicting a Fed pivot as soon as the summer. That's just a couple months away. And the markets have been, fairly in rally mode this year. So there's a big disconnect between the stormy weather that the Fed kind of says it's preparing for, but you definitely see, Steve, and the markets who are looking out there and all they see are sunny skies, it seems.
The only thing that would really cause a sharp pivot at the Fed would be if there'd be some liquidity crisis on Wall Street or something like that. Then they will pivot fast. And it'll be the kind of thing that you won't really pick up in the market. It'll happen pretty suddenly, and they'll pivot pretty suddenly.
All right, I want to dig into that point in just a second, Steve. But real quick, the markets are, still relatively sanguine this year, certainly versus where they were last year. They do not seem to be pricing in the type of economic storm that you and I were just talking about here. So do you anticipate some sort of repricing in these markets when they begin to realize that it's not going to be as many sunshine and roses as they seem to be pricing in right now? And obviously, if there's a pivot, that'll change things, and I'll talk with you about that in a second here.
That's a good question. Of course, tricky, but the market the market's been kind of segmented, shall we say? So the big tech stocks have had a huge rally, actually.
Right.
And the rest of the market's been kind of in the doldrums and not doing very well. So if you look at the aggregate of everything, it looks like it's kind of, as you say, kind of sanguine. Well, if you look under the water, there's a lot of garbage going on. At the top tech part, it looks pretty sunny. So it's kind of stormy down below, but up the big guys in the tech world have been doing pretty well. So the question is, what should people be thinking about? And number one, in general, I subscribe to holding, high quality stocks that you like, and the investments for the long run. I'm not
Yeah.
talking about day trading and that kind of thing. So that's fine, but I would lighten up on the more iffy positions that you might have, and you can either go in money, go in cash, safe cash, either 2-year treasuries or good government money market fund. So that's one thing. Now the question.
Yeah, and I'm sorry to interject, but just because you mentioned it, so given the fact that you see these storm clouds ahead and that the main important trends are still continuing to deteriorate, like money supply, it's an uncertain time, and so being able to park yourself somewhere safe, like T-bills, and get paid for it in a way that they haven't been paying in a good long while, right? That's probably not so bad for somebody right now that doesn't have a lot of confidence on where else to invest. Would you agree with that?
Yeah, I completely agree with it. I mean, that's what I've done myself, but that's another matter. We don't need to get into that.
No. Okay.
But also, I said earlier, gold. Remember, I said something about gold. Well,
I do.
What did I say? I said about 6 months before recessions, gold starts getting strong, and it remains strong during the recession. So go. You want to go.
Let's go into gold. And gold has been picking up recently.
In kind of your safety zone, you want to include not only cash, let's say those 2-year T-bills, but you want also some gold.
Okay, and sorry to interject again, but gold has had a pretty strong run the past month or so. Do you see that as an indicator of this? Okay, we're getting to the point in the timeline where gold begins to sort of front run the coming recession.
Well, I would say, I'd put it this way. I think it's consistent with the fact that I think a recession is right around the corner based on the quantity theory of money. Based on the quantity theory of money, I think economic activity is going to slow down dramatically and we'll have some kind of recession. Okay, that's point one. Now, point two. So what, Hanke? You've got the thing baked in the cake, and what do I do? You're asking, what do I do? And one thing I would do, because I like gold and focus on gold, is that I'd want some gold in my portfolio. And why would I? Because I know that prior to recessions and during recessions, gold's history is to do well. So that's the gold thing, and the cash thing goes without saying. I mean, you said you're getting paid a little bit to be in 2-year T-bills, are perfectly liquid and safe and everything, and so that gets you out of the storm. You're on the sidelines. You're not going to get buffeted by winds and rain and all the rest of it, or tornado. And then you keep your high quality investment positions, and that's it.
Got it. And I'm guessing you would imagine be open to the fact that whatever you own going into a recession may go down in it, but if you're buying something that's quality, maybe has a good track record of paying dividends and whatnot, it'll weather the storm and come out okay on the other end.
Yeah, and then for me, there are different exotic things that for the general purpose person maybe aren't that in. I happen to like lithium, and lithium is boomed. I've been long lithium for a long. It's boomed. It's backed off, and I think it's probably pretty close to its lows. So, there are various specialties that if you study and know something about them, you want to be in them, and they're just a whole array of things. When I say good high quality investment positions that you have, that assumes you've actually studied the positions and know what in the world you're doing.
Right. You're hitting an important point here. I just want to get your commentary on, which is we've had a number of experts like you come on the channel of late and say, look, you know, for the past 20 plus years, for the most part, investors, passive investing has paid off, right? Because you had the central banks, at your back, they're pushing liquidity into the markets and being ready to intervene anytime the markets, got wobbly, right? The famous Fed put. We're not living in that world anymore. And so what I've been hearing from a lot of experts is look, active investing is really going to be the successful approach going forward, where you can't just close your eyes, buy a sector ETF and expect all boats to rise. You've really got to do your due diligence to find the diamonds in there and separate them from all the junk. Would you agree with that?
Yeah, but yes, I'd agree with what you just said, but backing up a little bit, I'm more a due diligence, drill down kind of person. So
guy, anyways, yeah.
I just so the market is one thing, but it's just not the way I'm wired. I like to drill down on very specific things. And
right. Well, I guess where I'm going with this is the way that we're wired, you and I think the way most of the viewers are wired here, which is that fundamentals do matter, right? But we've been in an era of investing, a pretty long era of investing, where the fundamentals got overwhelmed by a lot of intervention and other extraordinary measures that kind of dictated what went on. I believe we're entering an era where fundamentals are going to matter more again. Would you agree with that?
Yes.
Great. Okay.
Yeah, man. Right.
All right.
I think people will be in a position where they won't be able to push us off on the sidelines as they've been able to do in the last few years. Let's put it that way.
Great. That's exactly what I was going to.
Let's summarize what we were just talking about. So
great.
So I'm the kind of person looking at equities, for example, or anything. You can do the same with commodities. If it's equities, I don't want to buy the market. I buy a company. I buy companies. I don't buy markets. And the same with commodities. Okay, you can look at commodity indices and so forth, but I'm a commodity person, or currencies, for example. All these things are specific currencies. I want to trade specific currencies. I don't really want to trade a basket, and that's just my orientation. I'm not saying it's better or worse than other orientations, but that's the way I look at the world. I look at specific companies. I don't look at the market. I mean, I do look at the market. I shouldn't say that. I do look at the market. I want some ideas the market's going up or going down. Yes, that's fine. But I'm not into trading the index.
Got it. All right. Well put. Look, and a couple of specific questions about some commodities you mentioned. Gold, you track gold very closely. In fact, you, along with one of your partners there, have created a gold sentiment index. Yeah. Can you just talk really briefly about what that index is telling us right now?
Okay. Right now, as we speak today, I can't tell you because I've been so busy. I haven't had time to look at the index, but the index changes every hour. So it takes the temperature, the sentiment in the gold market every hour. It's based off very high frequency data. So let me walk you through how the thermometer works. It's like a barometer, basically. That's another thing. It's like a thermometer or barometer. And what we do, I do this with Abe Kaufness, and we call it the Hanke Kaufness Gold Sentiment Score that we produce every hour. So the score has a range. The biggest negative possibility is negative 15 versus a positive 15. So if it's and the way we measure it, we look at every article that's come out in the last hour, and with text mining, we have a dictionary of bullish and bearish words that the computer is able to allow us to read all these articles with what they call text mining, and we ultimately figure out, is this article bullish or is it bearish? And we accumulate all those articles every hour and come up with kind of an aggregate, let's say temperature or barometric pressure. Is this thing bullish now or bearish? And if it's bullish, what do you do? If it's highly bullish, you want to get out of your long position, liquidate that, and go short. If it's bearish, you want to do just the reverse. You want to get out of your short position and go long, because the sentiment is moving around all the time, and it's always reverting back. Once it gets an extreme, it will revert back the other way towards neutrality, or it could go from actually bullish all the way over to bearish. I mean, it could swing all the way. So it's measuring the temperature. It's not measuring the sentiment in the gold market for a long-term trend, for example. We talked about what we think is going to happen long-term in the gold market, anticipating a recession. So that means the long-term is going up. It's going up, getting stronger, going into the recession. But along the way, the prices will be going up and down, zigging and zagging all over the place. And this sentiment is based on high frequency data that allows you to catch those zigs and zags that are going up. Now, we had on the 4th of April, by the way, we had a huge negative reading. I'm holding up you can put that up for your readers. I think I sent it to you.
Yep, you did. We'll put this on the screen. Yep.
Yeah, a huge negative score popped up. Actually, early in the morning, the score was flipped over into -8. That's a very extreme score at 8 a.m. Then at 9 a.m., it went even more negative. It was -12. We put on a big position long, and what happened to gold? We caught a $37.50 move up in gold.
Wow.
Right after. So if you go back to the 4th, you'll see there was a huge upswing.
Yeah, I remember. It wasn't that long ago.
And this is a perfect example of how this sentiment thing works, when it works. It works most of the time, by the way. We've been running this thing now for a couple of years, and depending on the trading algorithm that's linked to the sentiment score. In other words, you get a sentiment score, but the question is, well, what do you do with the thing? I told you in general terms what you do, but you have to have an algorithm with trading rules in it, which we do. And depending on the algorithm, we've been generating returns that are in the 30 to 50% per year range. So very, very good performance with the thing. It's been working really like a charm. And if you want to find out more about it.
That was going to be my next question.
Yeah, let me just tell you. You go to our website, which I will read off. It's www.thehanke, the Gold Sentiment Report, all one word, thegoldsentimentreport.com. And you'll find out the various things we offer. The basic service is $15.95 a month, and you get 6 sentiment scores every day. But there are other things that you can get. Plus, you can get a free sample of this. Get 1 score a day, and give you some idea of what's going on. But that's the gold market, based on what sentiment, what temperature is driving the market on these very hour by hour. What's going on? So for people who want active trading, that's one way to do it. The other is if you want to be adding or subtracting from positions that you have that are more long-term fundamental, you want to see what the sentiment's doing, because that'll give you a pretty good idea of when to enter the market or exit the market. If you're thinking about selling a long position, you say, well, I've had it with this gold market, it's not doing what I want it to do. The question is, when do you get out? Well, you better know what the temperature of the market is with a Hanke Kaufman's gold score at that time, and it'll help you time your exit. Or if you want to get in or add to a long position, the sentiment score helps you with that also.
Well, Steve, that's great. Look, I will put up the URL on the screen here to the Gold Sentiment Report, so that interested investors can go, check out this service. And I do want to, long viewing Wealthion viewers here may remember when you came on this program, Steve, when you were in the beta testing phase for this, and a number of Wealthion's early viewers were some of the first to actually take this index out for a test drive. And it's great to see how far it's come since then. So congratulations to you on that. Real quick, as we wrap up here. Go ahead.
Yeah, we had a lot of Wealthion followers that actually got on board with us and have been there ever since our first session. So it's obviously something that is in interest to your viewers. They're interested in what's going on in the gold market and how you measure sentiment in the gold market.
Right, and looking for actionable, we're always looking for actionable resources. So it's great that you're continuing to optimize this one here. Real quick before you go, this is an unfair question to ask you, because I'm sure we could have made the whole interview about this topic. And we can have you back on anytime you like, Steve, and go deep into this. But I'd like to get your sentiment on the Bitcoin and crypto space, because you tend to write about it a lot on your Twitter feed. You've definitely got a very defined point of view on it. I want to read 2 quotes, and then I'll just let you go here. These are 2 quotes from your Twitter feed. First one is the U.S. Treasury says the decentralized cryptocurrency market threatens U.S. security. The U.S. Treasury has a point. Then your second one was in investment guru Paul Singer's interview with the Wall Street Journal. He articulates what I've been saying. There are thousands of cryptocurrencies. That's why they're worth 0. Anyone can make one. All they are is nothing with a marketing pitch, literally nothing. So I'd just like to get your latest kind of current sentiment on Bitcoin, cryptos. If you see any difference between Bitcoin and the rest of the cryptocurrencies. Every so often I get people asking me, Adam, talk to your guests about what they think about crypto. Since you have such a defined opinion, I wanted to give you a chance to give everybody your latest thoughts.
Okay, well, the latest really is that tweet that I put out. By the way, people can follow me at Steve_Hanke on Twitter. And that Paul Singer was interviewed over the weekend in the Wall Street Journal. I highly recommend that interview. It's very, very interesting. And I was in agreement generally with the interview. Let's put it that way. He's coming from things the same way I am. He had a small remark, pointed remark about cryptos that you quoted. I completely agree with that. So that's my current view. They can be produced by anyone and they're worth zero. Now, he was talking about Bitcoin in particular. So Bitcoin does fall into that category. Some of the other cryptos may not be worth zero. They might actually be backed by something. In most cases, we don't exactly know what, but that's another story. In general, that whole space, you're talking about a category of assets that's highly speculative. So if you like to go to Vegas, it's a place for you. I don't like to go to Vegas, so it's just not for me. I'm like Paul Singer. I mean, he's the kind of guy who likes to buy companies too, or Charlie Munger or Warren Buffett. I mean, those guys buy companies. That's what we do. But again, everyone's free to speculate. If you like to go to Vegas, I'm not going to tell you not to go. Go speculate and gamble to your heart's desire, but know what you're doing before you go. You're speculating on, in the case of Bitcoin, something with a fundamental value of zero.
Great, and that's really what I wanted to sort of get a clarity from you on, which is reading your Twitter feed. It seems to come across that you think, look, if you want to preserve and grow capital, you don't see cryptocurrencies, at least in general, as a place to do that. Obviously, if Bitcoin's got a fundamental value of zero, sounds like you don't think any money should really go in there. Are there any parts of the cryptocurrency universe where you think, well, this is one that's maybe worth keeping an eye on? Or do you just really say, look, yeah, people will spend money in all sorts of crazy things. If you want to just go and play in that world, whatever, fine. But that's not a place to build wealth sustainably.
That's a good summary of my position.
Okay.
Again, it's a Vegas kind of analogy. I mean, some people hit the jackpot. Let's face it.
But the odds are not in your favor, which is what you're saying.
The odds are not in your favor. Plus, it's even worse than that. In Vegas, what the house knows what the odds are, and you know what the odds are. With crypto, you don't.
All right, great. All right, well, look, I know we're going to get a bunch of crypto supporters here saying, Adam, you should have asked this whole litany of other questions. We're going to save that for a different day.
Yeah, you have to realize it's a religious movement more than an investment movement. I mean, people and Singer hit it on the nail. Read the last part of what Singer said. Read the last sentence, because Singer articulates the thing exactly the right way.
You're saying the sentence I read earlier?
Yeah, right.
All they are is nothing with the marketing pitch, literally nothing?
Yeah, the marketing pitch. It's something worth nothing. It's based on a lot of hot air. That's what Singer's saying. I agree with him.
All right, great. All right. And look, folks, for those of you who, if you want to hear the other side of the story from a credible, rational proponent of crypto, let me know their names in the comment section below. I'm totally open to bringing them on and letting them make the other case. But Steve, I appreciate you making your position on this super clear. And obviously, Paul Singer's a pretty smart guy as well. Well, look, Steve, you've given us another great hour. Thank you so much for your time and sharing your insights so transparently. Are there any parting either bits of advice or any key topics we didn't cover, things that you just would want to put on the radar of the average prudent investor who's watching this because they're trying to self-educate and probably most importantly, just make sure they don't become collateral damage to the storm you see coming?
The only thing I would say, two things. One, thank you for having me on again.
It's always a pleasure.
Session. But the other thing is, it's an old line, but if you're interested in accumulating wealth, you better first and foremost, rule number one, try to avoid losing money. You got to worry about making it, but you got to really focus on staying away from those traps that lose you capital. It's the drawdowns are much more important than the upside. And by the way, the drawdowns have been very small on the algorithms using the Hanke-Kaufman School sentiment. I told you what the returns are. They, depending on the algorithm, they've been between 30 and 50%. They're very high.
Yeah, those sound majorly impressive.
But what's more interesting than that is the fact that the drawdowns have been very low. That's the message. In other words, anyone listening, they say, "Oh boy, he's got something 30 to 50%. Oh, that's fine. That's the positive side." But the real interesting part is very small drawdowns.
All right. Well, thanks so much for all that, Steve. Real quick, for people who have really enjoyed this conversation, maybe for the few who weren't super aware of you beforehand, who would like to follow you and your work, besides going and checking out your gold sentiment score, besides going to following your Twitter feed, where else should they go? I believe you have a distribution list, correct?
Yeah, I do have a distribution list, and anyone who wants to get on it, just send me an email at Hanke, Hanke @jhu.edu, and request to be put on my distribution. I'll put you on right away.
Awesome, Steve. Thank you so much for offering that. I hope you don't live to regret it with all the many requests you're going to get from viewers to be added to it.
The ones who want it will send me emails, which is fine. It's not a big deal.
All right, Steve. Well, look, thanks so much. And Steve, look, you've done a magnificent job in this interview of really hammering home the main message of Wealthion, which is that if indeed the future is as uncertain and volatile as you've been telling us it's highly likely to be, it's really challenging for the average investor to navigate on their own, especially if they have a job and a family to focus on and they don't have the expertise of a university professor in economics such as yourself. So we highly recommend that folks work in concert with a professional financial advisor who takes into account all of the macro risks and challenges that you talked about today, Steve, and not only takes it into account in developing a personalized plan for the individual investor, but then actually sits there by their side and executes that plan for them. And folks, if you're watching and you have an advisor who's doing that for you, fantastic, you should stick with them. But if you don't, or you'd like a second opinion from one who does, consider scheduling a free consultation with the financial advisors that are endorsed by Wealthion. It's totally free, doesn't cost you anything. There's no commitment to work with these guys. They just offer it as a public service. To schedule one of those, just go fill out the short form over at wealthion.com. And if you've enjoyed having Steve on this program, folks, would like to see him come back on this channel soon, and other great caliber guests like him, please do me a favor, support this channel by hitting the like button, then clicking the red subscribe button below, as well as that little bell icon right next to it. Steve, I want to thank you so much again for sharing so much of your time and expertise with us today.
Adam, great to be with you. Have a great day.
Thanks so much. Everybody else, thanks so much for watching.